So let's go ahead and jump into this. There's going to be three parts. We're going to review the big five key themes that we've been talking about all year. We did this first before we even got to 2021 with five key themes for last year, and that seemed to work so well. And we got most of our predictions came true that we're doing it again this year. Then we're going to slip into the market recap, where we talk about what's already happened. Unfortunately, the headline for that section of the presentation is the indexes got hammered, and I'll show you just how badly they got hammered. And finally, we're going to wrap up with the market outlook. And the title there sounds a little bit contentious, and I'm looking forward to getting into a deeper explanation of it. But it's the Federal Reserve versus capitalism. And I'm really going to lay out some things to illustrate that point, and might cause a few people to sort of rethink how they view the role of the Federal Reserve in our financial system. So with that being said, let's go ahead and jump into the key themes. It's probably not a surprise to anybody that the stock markets have indeed struggled this year. So I'll say, unfortunately, we got the first key theme right, is all the pandemic monetary and fiscal stimulus ended. The markets just had a big pullback. We said public fixed income will suffer primarily due to rising rates from mismanaged inflation. We'll show you the numbers there in a minute. Extreme volatility at any time has certainly beset us. Just a few days ago, the Dow Jones Industrial Average opened down 500 points, only to end up 800 points. So it can be good, it can be bad, but the markets are definitely on the move. We're not going to spend much time talking about tax rates today, but I don't think we're getting a tax increase. Actually, we're getting a tax decrease this year, which I might have a chance to go into. And lastly, private markets can play a larger role in a lot of folks' portfolios. And I just have to mention this at this part of the presentation, even before I get into the data. You know, when we get to what public market fixed income has done, it's just shocking how badly the indexes have performed. Thank goodness when we invest in public markets, it's done much better than that, but that still can't hold a candle to what we've been able to deliver to our investors with private market fixed income. And since we're not going to spend much time on this private market theme today, let me just mention that there's a lot of product innovation coming. And in 2023, we think we're going to be able to reach some of our investors that historically haven't chosen to embrace the illiquidity of private markets, or maybe didn't meet certain minimums. We think we've solved a lot of those problems, so more news to come. All right, let's jump into the look back. And again, the headline is the indexes got hammered. So let's just show you how bad that was. First, with their BIP blended benchmark results. And this is the same page that you would have seen in your own quarterly portfolio report. We emailed you a few days back to say you can log into Client Care and take a look at how you did. So when I just look at the last 3 months, I see that the public market fixed income index was down almost as badly as the global equity index was down. So the benchmark returns for the quarter were down anywhere between 4.75% for a 100% fixed income portfolio to down 6.64% for a 100% equity portfolio. Now, with very few exceptions, our clients did significantly better than that. It all depends on your own particular portfolio, and again, how much you participated in private markets. You know, we've even got some folks that might have been able to generate a positive return if they were mostly in private markets for this particular quarter. It's not that shocking, I have to tell you, to see the stock market down 6.64% in a 90-day period. It's yet more bad news to add on to the first 2 quarters of the year. And it's kind of extreme to see us 9 months into 2022 down 25.72%. Again, this is not our clients' performance. This is the indexes and what they've done. But what is shocking is to see on the fixed income side just how bad it's been. In the first quarter of this year, we set some new records for how bad things could be in a quarter. And if we wrap up this year, as I think we will, without a massive rally in fixed income, we're absolutely setting a new record in 2022 for the worst year ever for fixed income indexes. We've just never seen it anywhere close to this bad. I'm glad that we warned our clients. I'm glad that we saw this coming. I'm glad that we made adjustments to our own portfolio allocations. That being said, with rates having risen as much as they have, I think the worst is probably behind us for fixed income, because now there's actually meaningful yields out there that we can get with that investment. So if we've dodged the bullet for most clients with this downturn, maybe it's going to be a little bit better going forward. If we take a peek at what the stock market did for the quarter, it was up, it was down. It looked for a bit like we were going to have a rally for the quarter, even if it was a small rally, but that turned out to not be the case. There was really more bad news than good. And when I began to list out the headlines that I thought might be significant for this past quarter, at first blush, they all sounded like they were bad. I started to put them all in red. But it actually turns out that there were a few that I decided maybe weren't such bad news after all, and I put those in green, and we'll come back to those issues. Now, if we look at what happened for the full year, that's the rectangular box that we've printed there to the left. What you can see is that the quarter's return is really just kind of consistent with what we've been seeing for the last year. Every time there's a rally, we turn around and give that back up and then lose a little bit more. When we look at the long term, the last couple of decades, which is the right rectangle there, what we see is that this quarter does really stand out. Actually, it's that year that I've highlighted in blue. That's kind of the simple test that I like to apply when the markets are being volatile is, let's put this in a 20-year chart and see if it actually stands out. Sometimes market events seem quite dramatic when they're happening, but if you take a bigger picture view over multiple decades, it doesn't look like such a big deal. That's really not the case for this past year. It's a pretty big deal to see how far down the markets have actually dropped. As we go into the major market returns, where I sometimes get to show 5 green arrows or 6 green arrows, today, unfortunately, I'm showing 6 red arrows. Everything was down. So almost every index got hammered. I think there's one sub-index we're going to see in a minute where things were maybe up just slightly, but certainly not year to date or for the last 12 months. So the US stock market did better than other stock markets around the world. I'm going to show you some data in a few minutes on why a lot of that was just due to currency translation. Currency translations really hurt the international developed stock market and the emerging stock market. But no broad index did well for the quarter. Everything experienced some pain. Now, at the bottom of this chart, I circle the best quarterly returns we've seen in the last few decades in green and the worst in red. So we didn't set any new records this quarter for the worst, although there was not any good news out there to report. And as I said before, in the first quarter of this year, we set records for the worst quarter for US fixed income and for global fixed income. So it was almost that bad this quarter, but not quite. So no new records. Now we really start to break things down, and you'll see that one sub-index at the top right there, small cap growth in the US, that barely eked out a gain, and large value is what did the worst. Now, this is really running counter to what we saw in the first 2 quarters of the year, and it's definitely run counter into what we've seen since September 30th, when this data was put together. So maybe a little bit of a bounce in the sense of things reversing themselves temporarily, but we very definitely moved back into the phase where value is outperforming growth. So if you look at the year-to-date numbers, if you look at the 1-year numbers, you can definitely see where anything with the word value in any part of the market that's value, and we're value investors here. All of you are value investors when you're with us, that's been the better place to be. It's gone down significantly less. A bit of a similar story in international developed markets. You know, the US is up to 61% of the total, and international developed is down to 28% of the total, and the total being the entire globe's stock market value. Just a couple of years ago, international developed market stocks were closer to 40%. But the US continues to outperform, and a lot of that's due to currencies. In fact, you can see the currency effect for the top right quadrant of this page, where I'm showing you the returns in light gray that we got out of the markets before the currency translation. But because the dollar strengthened and these foreign currencies weakened, we actually lost far more on the currency translation than we did just by being invested in those foreign stock markets. That's just how significant those foreign currencies slipped relative to the dollar. Now, there's one other effect that comes out of that, and that's the inflation impact on these foreign countries. If you imagine that you're buying everything in euros, and naturally some of the folks in the European Union are buying goods from America, you need a lot more euros when the euro is weaker to buy those American goods. So with those foreign currencies slipping relative to the dollar, inflation is even higher outside of the US. Now, if the Federal Reserve decides to stop raising rates so quickly, we could see a fairly rapid reversal of that, which would mean that we would get a boost to our foreign stock market returns. And that's one reason that we want to keep a dog in that fight, meaning invest outside of the US at least to some degree, so that when that happens, when the US currency weakens, then that broader net of opportunity yields some better returns for us. So we do overweight the US a bit, and we adjusted that up even more this year, I'm happy to say, but we could very easily, if the Fed gives us some good news, see that foreign equity markets are the best place to invest next quarter. Emerging markets are telling a story that's pretty similar to what we saw in all the developed markets, except that small caps had a bit of a bigger rally there. But again, it's largely the same, and the currency effect was no help for US dollar-based investors. That part of the global equity index is down to about 11%. It's more like 8 or 9% for all of you with your public market portfolios that we're managing. But the currency effect and the market effect together combined to make it a pretty bad quarter for emerging markets, to add to a number of other bad quarters. In fact, now we have to get back to more than 5 years to really see some overall good news from investing in emerging markets. That's just how severe this downturn has been this year. When we get into REITs, real estate investment trusts, we don't have any good news to share there as well. We do have a US bias, and that meant that our clients' REIT exposure went down a little bit less than the global average. Now, this is only about 5% of our clients' equity portfolios, and sometimes I wish that it was more than 5. This past quarter is one where I'm happy that it was only 5. Sometimes REITs, because of their high dividend yield, actually behave a little bit more like fixed income. And with rapidly rising interest rates, the market has priced them just like it has, let's say, longer term treasury bonds this quarter. And we saw that fall off. When rates rise, that 4 or 5% dividend suddenly doesn't seem quite so special anymore. So I think that we got a discount this quarter on prices, largely due to rising interest rates. I'm showing a commodity price chart here, not because we invest directly in commodities. Instead, we tend to invest in some companies that have some commodity exposure that are able to turn a profit with those. So for instance, if you have a value tilt to your portfolio, now you probably have some exposure to some ExxonMobil, other oil producers that would actually own some commodities. Now, it's worth noting that there was a big sell-off in oil, although some of those value stocks still did fairly well for the quarter and are expected to continue to do well. But this is the second quarter in a row where there's been a pretty big sell-off in commodities. So from this perspective, there's been some big easing in inflationary pressures. It's certainly an argument, 2 really bad quarters in a row for commodity prices, to suggest that the Fed could go ahead and slow down its rate of interest rate increases, or if I had my way, even stop raising interest rates. It's part of the thesis that I'm putting out there that I think we've already seen our peak in inflation. I think it's going to stay high, but has probably peaked already. Now, the one thing that I'm sure could make me wrong there is if the US dollar for some reason suddenly slipped, all those things that Americans buy from abroad would then suddenly become more expensive. And so instead of us exporting inflation to the rest of the world, we would begin to bring it back with a weaker US dollar. And then here's my favorite slide. I think it is the most dense with data, but I want to point out just a few things for you to take away. If we look at the top middle of this page, we see what we call the yield curve. And this is for treasury bonds. So these are the safest bonds in the world, no matter what you think about the fiscal situation for the federal government. And I think we're going to talk about that some next quarter. US Treasury bonds are still considered the safest in the world. So this isn't corporate bonds, or far worse than that would be junk bonds. These are safe bonds. And if you look at the interest rate that they're selling at 1 year ago, 3 months ago, and today, you'll see some dramatic changes. Now, for those of us used to looking at these curves, there's some things that immediately jump out. Now, the first is that when one of these curves is severely bent, it tells you that there's something kind of strange going on in the market. Well, that was the case 3 months ago, and it's clearly the case now. The short end of the curve from 3 months out to about 1 to 2 to 3 years is pretty severely bent. And what that tells you is that the market has expectations for where rates are going to go, but when that short-term rate is considerably lower, it just tells you that the Federal Reserve is really behind the times. The market knows what it's going to do. It's already priced that in with longer-term bonds, and it's just waiting for the Fed to catch up with reality. So the Fed has telegraphed that it does, in fact, intend to raise rates. It would be a nice surprise next week if we learned that maybe it was going to change path a little, but we've had some pretty severe dislocations and bends in that curve. The other thing that should jump out to you is just how far rates have moved in the last 12 months. Now, there's another way to see that other than just that green curve moving up to the gray curve, and that's in some of the bond market index returns that you'll see in the table in the bottom right. On the very bottom is what we call the US government long index. So think of buying 30-year treasury bonds. And if you bought a 30-year treasury bond about a year ago, you were going to receive 2% per year for 30 years. Well, now the going rate is 4% per year. So if you had bought that bond a year ago, you're now looking at 29 more years of really uncompetitive returns. So if you tried to sell that bond in your brokerage account, you wouldn't get nearly as much as you paid for it. And in fact, if we look at the year-to-date return of that long treasury bond index, the bond index is down 28.77%. So that one part of the bond market you see there is probably the part that you'll never see us at BIP Wealth invest your dollars into. It would have to be some pretty rare circumstances where we thought it made sense to do that, because you can end up with stock market like volatility for what in this case now over the last 10 years amounts to a 0.6% return per year on average. Well, that's the past. It's behind us all. We all got what we got. As you were looking at the year-to-date numbers and seeing how much better value did than growth for the equity markets, you can see why I'm telling you that I think our clients did a lot better. On the fixed income front, we took a lot of that risk off the table. We really went in the opposite direction of those long bonds. Now, let's talk about what we're going to expect to see going forward with our market outlook. And the headline there, as I've said before, is the Federal Reserve versus capitalism. So let's dive into that topic. The Federal Reserve has 3 mandates, although sometimes it's referred to as the dual mandate. If you maximize employment and keep prices stable, they say, moderate long-term interest rates will just take care of themselves. So really, the Fed has 2 jobs: maximum employment and stable prices. Now let's review the fundamentals of capitalism for just a moment. Capitalism as an economic concept has been in the news a lot, really over the last decade and a half. You may remember back to some of the Wall Street protests, and in fact, the outrage that many Americans felt after how the government went about solving some of the economic problems from the Great Recession. See, the federal government was very, very involved in the markets, and I'm going to point out how that could be bad. But if you just want to say, let's define capitalism in maybe some of the simpler terms, you'd say, well, there's private ownership of industry, and that's really not much of a problem in this country. We tend to have private ownership. We don't have that history that some countries have of, say, nationalizing the oil companies and doing some things like that. Now, the federal government owns a lot of land. There's a lot of licensing. There's a lot of regulation. But even in most cities, if the government decides to take over, the corner of some street somewhere to widen the road and, give a better turn, and, somebody loses the gas station they've owned for 30 years there. I mean, it's front page news and it's fought out in the courts. So unlike a lot of other countries around the world, we do tend to embrace private ownership. The second aspect of capitalism that's important is the profit motive. Now, just like private ownership, profit motive is not without some government constraints. The government taxes us. I did mention that taxes are actually dropping this year. With the high rates of inflation that we're having, the tax brackets move up quite a bit. I've got a note at the end of the presentation about just how much they move up. So we're actually all getting a tax cut if we look at how far the brackets have moved up. But the profit motive, to my mind, is something that's alive and well in just about every single human being. I think you have to be convinced not to be motivated by profits. There's even experiments that have been done with primates to see that this seems to be almost a mammalian trait, not just a human trait. And even within human society, whether you're talking about a Mexican drug cartel or the suburban kid selling joints to his friends at school, or the mafia, you have legal profit motives, you have illegal profit motives, but every economic player, legal or illegal, large or small, seems to naturally orient themselves towards the profit motive. And then, of course, there is also, the basic human charity, the decency, the giving, the caring for others that is laid on top of that. But in terms of what motivates most people to get out of bed in the morning, knowing they can own something, knowing they can make money, is a big part of that. And then lastly, and what I'll say is the most important part of capitalism, is what we'll call free markets. And so there's a long, well-documented history of governments interfering with free markets. Again, they can have taxes and they can regulate things, they can have safety in the workplace or whatever, and we're still capitalist. But when you begin to make it so that markets aren't free, we run into some real problems. And what's happened with the Federal Reserve over the last couple of decades is that they have encroached more and more on what would otherwise be free markets. In fact, to help get us out of the Great Recession, the federal government stepped in numerous instances, decided what companies would survive, what companies would fail, what investors got compensated for the risk, which ones did not. And of course, as we've talked about already today, there is a market for yield, a market for interest rates, and the Federal Reserve is massively involved in that. And one of the results of this is that market participants, like we all are in numerous ways, including as investors, are unable to properly price risk. We don't know when the government is in our corner, which it has been for investors for a number of years, or seemingly against us, which it seems to be right now. So as that policy changes, we're left as investors having to adjust, because it's not just about markets anymore, it's about the government. And so when you can't properly price risk, market participants tend to make a lot of bad decisions. And certainly evidence of that is what's going on this year with a lot of tech stocks that are down far worse than the indexes that I've shown you. Let's review the Fed's two jobs. Remember, the third job, stable long-term interest rates, is supposed to take care of itself. Let's look at the first goal of maximum employment. Well, this blue line is the unemployment rate. And this is a chart that I've shown before, but let me remind you what the green line and the red line are. So the red line is actually a summary of the economic projections. It's known as the separate economic projections from all the members of the Federal Reserve that constitute what's known as the Federal Open Market Committee. And they've come up with a number that they say is maximum employment. And what you see is that the actual unemployment rate dipped below that well over a year ago. Now there's another line that the CBO, the Congressional Budget Office, comes up with. And that line at the moment is a little bit higher, but we also dipped below that, a month or two before we dipped below the others. So our employment market has been incredibly strong. It actually continues to be incredibly strong. There is a significant lack of workers across every part of the workforce. It's a great time to be looking for a job, because if you want a job, you can pretty much get a job somewhere. And that's actually leading to inflation of wages, but it's an incredibly strong market. And so if you say the Federal Reserve is in charge of doing this, making this happen, well, that was achieved well over a year ago. The problems from the pandemic did not last long. And yet they've continued to stimulate the economy as if they simply did not see this data. The next job that the Federal Reserve has is stable prices. So let's just say that low inflation would be another way to say that. And we're going to look at the Fed's target for inflation, which has been 2% for quite some time. So the dotted line you see on the slide is 2%. And so 18 months ago, inflation began ripping right through that target. Now, as you can see from the history, it's been above it and below it at other times, but it became apparent pretty quickly that inflation was going to continue to head up. All of the policies that the Federal Reserve had in place were going to be ones that increased inflation. So the Federal Reserve was adding to its balance sheet. It was keeping interest rates at zero. In fact, it was keeping interest rates at zero until about April of this year, still stimulating the market when we actually had problems with employment because the economy was too strong. We already having problems with inflation where it was taking off, and the Federal Reserve just absolutely seemed to have blinders on and continue to interfere with that market in a way that was even inconsistent with their own stated goals. So I talked about interest rates, and we look at rates all the time. Let me just remind folks about this other tool that the Federal Reserve has. Now, nobody thought too much about the Federal Reserve's ability to manipulate the money supply until the Great Recession. And so the Federal Reserve increased the money supply, which helped the stock market to recover. It didn't necessarily help the man on the street. Again, it was the Wall Street versus Main Street dilemma. But everybody on this call is an investor, so we got helped by that. But as we look back, what we see is that that increase in money supply achieved through something known as quantitative easing was relatively minor. We thought it was a big deal at the time. But look at what happened in the pandemic. We had a recession that lasted a mere 3 months because of all the stimulus that was thrown at it. But the Federal Reserve continued to increase the money supply again until spring of this year. As we just showed in the other slides, inflation was taking off. The employment market was too strong, and they continued to increase the money supply. So now they're letting the money supply stay constant. It's debated as to what pace they may actually shrink the money supply, but we've still got all that extra money kicking around. So of course we have inflation. The idea that politicians and economists would be saying that inflation would just be transitory just absolutely stuns me. It didn't make sense then. And if you'll recall back, we began ringing the warning bell on inflation over 2 years ago. If you want to see how the Fed is reacting now, as it is forced to acknowledge its mistakes, we see with the black line there, the pace of rate increases. And what we're showing here is how fast rates have been increased. The horizontal axis is months and the vertical axis is the rate. And you see for every other tightening cycle that we've had in modern history, it was much more gradual. We didn't think they were gradual when they were happening, but this 75 basis points every meeting kind of pace is just truly stunning. Now, just the way events have unfolded with China's pandemic policies that have gummed up the supply chain and Russia invading Ukraine has now meant that we're likely to have inflation in the mid to high single digits, really no matter what the Fed does. So the Fed certainly contributed to inflation being as high as it is now, but world events have overtaken them. Those world events are inflationary also, but they may be so significant in terms of making certain supplies not available that it won't matter how high the Fed raises rates. We're still going to have that inflation. And the big concern is that the Fed doesn't understand this and just continues to raise rates way too much. I think they've already gone a little bit too far. I wish that at this point they would just stop and let markets be markets. Capitalism has a wonderful way of dealing with this. Ford has tens of thousands of F-150s it can't even push out of its factories because it can't get the blue oval to stick on the front of the trucks to say it's a Ford. This is just almost a funny anecdote about how significant the supply chain problems are. All the car makers suffer from problems where they've got trucks and cars otherwise complete except for one or two parts that are missed. But it's really every type of industrial production. We still got problems with electronics and chips across all parts of a modern economy where you just can't get the supplies in time to ship the product. So all of these are parts of what we call the supply curve. And all of the Fed's tools are really oriented around manipulating demand. So if we're going to have problems with the supply curve, we're going to have inflation. And I just really have to hope that the Federal Reserve is not committed to completely crushing demand by forcing us into a severe recession just to get inflation down. I mean, when rates get raised this much, who's affected? When inflation is this bad, who's affected? It's the folks with a lot of credit card debt. It tends to be folks that are renting instead of buying a home, or they bought a home and they got an adjustable rate mortgage because they were just trying to get their monthly payments a little bit lower. Well, all of those folks are feeling severe pain right now. And unfortunately, if the Fed puts a lot of people out of work, those are the ones that are going to lose their jobs. So it's hard to believe that the Fed policies that we're staring into right now are actually going to be a help to a major part of the U.S. economy. So what has the Fed told us they're going to do? Well, let's rewind to August and read something that Jerome Powell, the chair of the Federal Reserve, said. He said, restoring price stability, that means lowering inflation, will take some time and requires us using our tools forcefully to bring demand and supply into better balance. So they're going to use their tools forcefully to try to get rid of inflation. Again, perhaps not understanding that a lot of the inflation we're facing now is a problem with the supply curve, something that they really can't affect. He goes on to say reducing inflation is likely to require a sustained period of below trend growth. Now, at least he's saying growth. That doesn't sound like a recession, but I guess you can have negative growth and that could give us a recession. Moreover, there will very likely be some softening of labor market conditions, which is another way of saying putting people out of a job. While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they're going to bring pain to households and businesses. So let's take a step back. Jerome Powell says that these are the unfortunate costs of reducing inflation that they helped to make worse and is now largely in the hands of world events. But they're determined to crush that, and they're ready to bring the pain. So this is clearly a case of the Federal Reserve stepping back into markets in a major way to change how risk is priced. Now, anybody that bought fixed income is being punished quite dramatically for them simply accepting what the market thought was the right price a year ago. So again, I'm glad we had some insight that the Federal Reserve was going to get this wrong for the benefit of our clients, but a lot of folks were not so fortunate. So the Federal Reserve's commitment to interfere with free markets yet again, having gotten it wrong on the downside, now maybe getting it wrong on the upside, means that we're not truly operating in a capitalist economy. In September, Jerome Powell came back and added to his prior comments that had worried the markets. They said, for the longer term, what we need is supply and demand to get better aligned so that housing prices go up at a reasonable level. So again, at first blush, he seems to be saying that housing prices will go up, but I think he's actually saying something different from that. He said, so that people can afford houses again. From a sort of business cycle standpoint, this difficult correction should put the housing market back into better balance. So actually what Jerome Powell is saying is that for any of us on this call that have a home, he would like to make it sell at a significantly lower price a year from now or 2 years from now than it would right now. So Jerome Powell is intent on removing equity out of all of our homes. So that might be good for the future buyer, although not if they're out of work, but it's certainly not good for somebody who's already made an investment in that home. So there's nothing in the Fed's mandate that says that it's supposed to go in and manipulate housing prices. And yet Jerome Powell has embraced this as a goal of his own, believing that that is somehow part of his mission. So I really struggle to believe that that is within his current congressional mandate. And I think that's just one of the reasons why maybe the Federal Reserve is right for an adjustment of their mandate. Even the mandate they currently have is not one that's being executed well, but maybe restricting that mandate and being more precise is something that could allow the U.S. economy to operate as more of a capitalist economy. So we've talked a lot about what the markets have already done. We've talked about the gamble that the Federal Reserve is going to be able to recover from its past mistakes and maybe not whipsaw us by going too far in the opposite direction of what it was doing until April of this year. But let's just take a big step back and look at the U.S. economy. I do this in some way because we're in election season, and I just want to provide a completely unpolitical view of what the economy is doing right now. And really the best way to describe the US economy is to say that it's bouncing off the ceiling. So think of a balloon that you let go of inside, a helium balloon, and it rises up and it hits the ceiling and bounces, right? So we've now had 2 quarters of negative GDP. So for the last 2 quarters, GDP has come down a little bit. 0.6% and 1.6%, I believe, were the final numbers after the second correction of those numbers. It may very well be up this next quarter. And so, it is common for people to say 2 negative quarters constitutes a recession. But the recession word is really a political word, and that word is being used a lot in this political season. If you choose to accept the definition that 2 negative quarters of GDP is a recession, then we're in a recession. But I think the bigger picture view, and the one economists would take, is to say that the labels are not valuable in any way. Let's just look at the data. And what's happening, at least to this point, is that the economy is fighting back. So I mentioned Ford earlier. They've created a C-suite position that is the chief supply chain officer. Capitalists are innovative entrepreneurial people that will take these market conditions and try to figure out the way to work around them. Hundreds, thousands of US companies are figuring out how to make more and more in the US instead of being dependent upon Asian economies to deliver them their most critical supplies. It's probably one of the reasons that US employment might continue to be strong no matter what the Fed does for years to come. I think it's entirely possible that BIP Wealth will continue to raise its overweight to the US within our global equity allocation. But if you just look at the US economy, so far it's fighting back. We're not seeing a severe downturn. And let's just remember that when we talk about a recession in historical terms, the gray bars that we put on charts, the gray bars that come directly from the Federal Reserve, actually come from a group called the National Bureau of Economic Research. Now, they're not part of the government. They're located in Cambridge, Massachusetts. It's a bunch of pretty smart economists who endeavor to be non-political, non-partisan. And I have my doubts, at least based on the history that's passed so far here this year, that they're going to come back and label that a recession. But they do tend to do it after the fact, and we'll see. They're the smart ones that said the pandemic recession only lasted 3 months. And then, obviously the Federal Reserve didn't pay much attention to that. So we might know here soon if they're going to look back at this and say, yes, indeed, we're in a recession. But again, from my perspective, it's really the data that matters, not the label. One, as we're getting down to the end of the presentation, one slide that I've been showing all this year and last year was retail sales. And if you need evidence for how strong the U.S. economy is, just look at what's going on with retail sales. It was initially sent rocketing upwards because of all the pandemic stimulus, the PPL and the various safety net benefits that were put out there, put cash in the hands of a lot of people in the economy. Of course, the Fed is pumping up the money supply. So you get this jump in retail sales, but our economy has held on to that. Even if we keep it level for a bit, it's absolutely amazing to see just how far up it's risen. So there's a lot of businesses out there that are doing quite well. In fact, many of these businesses could sell even more if the supply chain problems were eliminated. So let's say China suddenly decides that it's going to change its strategy. Xi Jinping had a big meeting just a few days back where he declared victory for a lot of his policies. And it's entirely possible that that's what's going to allow him to now pivot and say, our new policy is to get back to work. And then all of a sudden, all these Chinese manufacturers would be back at 100%. And that could certainly ease supply chain problems, bring down inflation, and allow Ford to get its trucks out of the factory and Tesla to get the batteries that it's looking for, and help thousands of other companies out there. Of course, if Russia were to pull out of Ukraine and agricultural and chemical commodities were suddenly available at a reduced price, that would take care of inflation, and all the producers out there that are lacking these raw materials would suddenly have those. So we could actually see retail sales skyrocket even more if certain world events were to transpire that, again, has nothing to do with anything the Federal Reserve is contemplating. And lastly, just one more perspective on what the economy is doing. If you take a look at the red line there, that's something called the Weekly Economic Index. And it's looking at a bunch of other pieces of data, about 10 different pieces of data to come up with this number. And, we have to wait many, many months to get our GDP number after a quarter has ended. But the Weekly Economic Index gives us almost exactly the same read in real time. So what we see with that is that the WEI has been coming down, but really at this moment, it's simply down to the sustainable level. So the direction looks concerning, but if it flattens off here, that's actually fine. That's the level we need to be at. If you look at the blue line, that's a line of GDP. Now, you don't see a negative number there. You see only positive numbers. They're simply choosing to graph GDP, and this comes from the Dallas Federal Reserve. They're simply graphing what is the economy not compared to a quarter ago, but to a year ago. And so if you're looking at a 12-month look back, actually the economy is still bigger than it was 12 months ago. And so by that statistical choice, we still have positive GDP. So the WEI and the GDP is measured on an annual basis, tend to track each other extremely closely. So if they don't go any lower than they are right now, then we're fine. We're simply back down to that sustainable level of growth. So kind of putting a bow on things, if we go back to the National Bureau of Economic Research's definition of a recession, and again, a lot of politicians will differ. You may differ. You may look at the 2 quarters of negative growth definition. Again, that's fine. This is simply the data for the NBER definition of a recession, that probability as it stands today is about 1.5% that we'll have a recession in the near future. So kind of interesting to see. If you get out your magnifying glass and look at this chart, you'll see that this measure does tend to give us a bit of a warning before we get into a recession as defined by the NBER. Now, we didn't do that for the pandemic because again, that was a shock to the economy, world events that overtook anything that was going on economically. And so really, this was not a useful statistic at that time. But for economically generated recessions, such as back in the Great Recession, when we had a housing crisis because the federal government overstimulated the housing market, that was certainly one of the big causes there, we do tend to get at least a few months warning. So it's a little bit comforting to see that that's a kind of a positive note to begin to wrap things up on. So let's see if we can sort of bring this presentation to a close here. Just a quick reminder to all of you that are investors that BIP Wealth has what I'll call a very full toolbox of investing tools. They're the ones that all advisors have. You can be in cash, you can be in fixed income, you can be in equities. But then we have a couple of different option-based strategies that have served investors incredibly well this year. And then, of course, we have everybody's favorite, I think, that invests in them, private fixed income, and indeed private equity. And so if you're invested in private fixed income that's got a run rate of 12% over the last 12 months versus in the public fixed income index that's down about 15 over the same period of time, that's quite a difference in the rate of return. And of course, any of our clients that have been with us for more than a few years and invested in private equity don't really need me to tell them how well that has tended to work out. So we've got a much bigger toolbox. And again, with some product innovation coming for these private types of investments in 2023, we think we're going to be able to offer the whole box of tools to just about every single one of our investors. So just the final thoughts. We went through the key themes. I'm sorry that we were as right as we were. We know it's been a rough year for most clients, although again, there's some that have done fairly well in comparison to the indexes. I think inflation has likely peaked, but will stay high because it's become a bit embedded. I think the job market will stay tight in the US. And so even if we look back and say, yes, indeed, we're in a recession, it's going to be the only recession in the history books where we had a job market so strong that pretty much anyone that wanted a job could get one. So again, by the NBER definition of a recession, it doesn't look like it's imminent, but we could end up with a recession outside of the US that drags the US into it. If we think ahead another 6 or 9 months, that's still very much a possibility. So just want to go ahead and wrap things up here and say thank you to everybody that has put your trust in us. I think we're doing a real good job for everybody. And I just hope that everyone on the call here is having discussions with your personal wealth advisor about what's the best strategy for the risk that makes sense for you.